It's breaking. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, an economic meltdown is imminent, and I'm going to show you why it's going to be far worse than we thought. Now, we're filming today's show from inside the steel mill, which will make perfect sense later on in the show. But before we get to that, I want to show you why policymakers, despite all the information and all of their credibility, cannot see the economy breaking right in front of their eyes. And the data we got today will prove it. Let's over to Bloomberg, where we picked today's story up with a headline. Janet Yellen sees disinflation pressures at work as hiring surge fades. Now remember, of course, we know that Treasury Secretary Janet Yellen, former Fed chair, one of her favorite statistics is the job openings and labor turnover survey. So let's check out what she's saying about the economy. The intensity of hiring demands on part of firms has subsided, she said in a recent interview. The labor market's cooling without there being any real distress associated with it. Now, this is something that policymakers want to see. They want to see the labor market cool off because what they're afraid of is what's called a wage price spiral, where labor is such in demand that employers are forced to continue to raise their wages, which turns into an increased demand and increased inflation. So in every sense, what they want to see is fewer people get jobs. They want to see people stay on the unemployment line for a little longer than they want because they need employers to stop giving out big raises. And there's a good reason why they want this. Because when we look at the job openings and labor turnover survey, this is shown in blue. We're going to put this up against the Wilshire 5000 price index because what I want you to see is job openings are very much keyed to the stock market, except a couple of times. So generally when you see job openings rising, you see the stock market rising. And when you see them falling together, well, it generally means, as we see here during the global financial crisis and the dot-com bubble, we're in a recession. So what we're seeing, what she's saying right now is, look, job openings are cooling off, but the economy's doing just fine. And what she's looking at this by saying is, look, that means employers are not giving out as big of raises because they're pulling off these signs that says we need labor, help wanted. That's starting to go away, and that will put some downward pressure on wage gains and should help bring inflation down. But what I want you to see is there's two parts I've circled here. One is when the stock market rallied, you see it going into the pandemic as job openings were subsiding. When that happens, usually there's a correction to the downside in the market. You're seeing that set up here again. The market is rallying as job openings continue to fade. But one thing that she's missing out, saying, look, the labor market is holding up rather well. Well, not quite, because there's a lagged effect here. You look at job openings again, shown in blue, but now we're going to put the 4-week moving average of initial claims in red. So what I want you to understand here is, in what we go back to the chart in a moment, is that when employers realize that they don't have the demand and so they don't need as many employees, they start to first pull the job openings. And once those are gone and they're still seeing demand being weak, well, the next thing they do is start to lay off. And that's why these two lines almost look to be a mirror of each other. But what we can note is that job openings go down, leading the 4-week moving average initial claims higher. So what she's saying is, look, we're seeing no negative effects on the labor market, but what we're showing here is with a lag, and of course we'll get this data this Thursday and every Thursday, is perhaps that employers are going to soon start laying off. Along with job market shifts, Yellen cited housing costs and vehicle prices among factors that are likely to keep pushing down cost pressures. She also suggested that corporate profit margins could play a role. And at the same time, she urged against excessive optimism based solely on June's consumer price data. So what she's noting is the higher costs of cars and homes mean that people can't afford them, and that tends to put a little bit of downward pressure as demand goes away. As we know, price tends to come down, but she wants you to really understand here, don't look at this last month's CPI report and say it's a one and done and that we're almost at our target, even though we actually are pretty close. Here you can see in this chart of the consumer price index shown against U.S. regular all formulations gas price, that in red. And what we can note is a very strong relationship between consumer prices and gas prices, and where gas prices are headed here suggests that inflation is going to be back under its 2% target, perhaps in another month or two, even though policymakers are saying, as you can see it, hey, don't get optimistic about this. Well, you could be, because it's telling us inflation's coming down. And receding inflation has prompted economists and investors to reassess recession risk. Goldman Sachs on Monday scaled back the estimate of its odds of a downturn to 20%. And JP Morgan Chase started turning bearish on markets last December, said the path to a soft landing is modestly wider now. So again, everyone's starting to believe, and that's one of the reasons, people ask, why is the market going up? Well, that's one of the reasons, is people are now saying a recession is becoming less likely, but that's not the truth. In the interview, Yellen cautioned against reading too much into the June data again, just calling it 1 month's numbers. Well, 1 month tends to lead to 2 and then to 3. But one of the things we've talked about on the show is why the consumer price data is actually a proxy of demand. So here you can go back to the 80s where we really see this shift. And in the 80s, we saw inflation come way off its peak, and we had 2 recessions. Those 2 gray bars are recessions. And then we look here in the early 90s, inflation comes down as we have a recession. Again, demand falling. You see it here in the dot-com bubble, again in the global financial crisis. And now they're saying, look, out of the last 1, 2, 3, 4 times we've had these big drops of inflation, we had a recession. Well, this time we're not going to have one. And even though we almost had one in 2015, it was very close. They're saying, look, this time is different. But what they're missing the point is the fact that inflation's coming down is a sign that demand is coming down. And when demand comes down, well, the economy slows with it. Housing had a reduced contribution, and there's every reason to believe that that will continue and come down further. Well, she's right about that. I'll show you that in a moment. That's an important thing to influence the core inflation because it's a huge component of the core inflation. As rent inflation in the U.S. has been slow to drop because of the length of typical leases and the fact of the way they calculate it. And here you can see in this chart, we have the rent of primary residence shown in red against the headline consumer price index in blue. And notably what you see is the CPI can come way down and rents are very slow to roll over and follow down. And when they do, it puts downward pressure on the core CPI. So here we're seeing just the initial signs that this is rolling over. We know it's not going to come straight down. We know it's going to be a gradual path lower, putting downward pressure again on that core CPI. As you recall, the Fed has changed the benchmark from the headline to the core now, so that gives them some more latitude to allegedly hike, even as we watch the headline CPI likely fall below 2% in the coming months. The improvement in U.S. inflation trends is contrasted with suggestions that outright deflationary risks in China. We talked about that in the show yesterday. Of course, where deflation hits in China eventually hits U.S. consumer prices with a lag. The Treasury chief on Monday said while China's slowdown could have negative spillovers, she still saw the U.S. averting a recession. I almost have no comment on that because we know we're headed into recession. We've looked at all the data, but one thing that shouldn't be headed into recession, well, that's your trading account. Giving you an update, I checked the charts today. This is a soybean trade that our CTA-Timer Pro, it was saying back short, max short, and we've told our subscribers, look, when you see the fast and the slow algorithms at max short positions, look for the reversal, take a trade when you see the signal or your own signals, and then add into it. Of course, always use a stop loss. Had you done this on this day right here, I believe this was the 9th, it signaled this is where you should buy at open because we send the reports out before market open, you'd be up over 14% at the time of filming. Here you can see on June 8th, they were max short, and we had notes out to our subscribers saying, look for a reversal. When you see it, trade it. There it was on the 9th. It started to flip. You can check your charts, up 14%. Had you done that, paid for probably your subscription. Link in the description below. Yellen has consistently said it's possible to bring inflation back to the Fed's 2% target without a spike in joblessness, a view that has been seen overly optimistic in some quarters. And my friends, we are going to totally put that to the challenge, as if we already showed that when job openings go down, that we see layoffs go up. Well, it's going to get even worse as we get into today's data. We're not seeing firms actively reduce their headcount. Well, not yet, but wait, that's coming soon, except in a few hard-hit sectors like tech, she said. We're not seeing them lay off workers. It's just the intensity with which they're trying to add to their workforce seems like it's reduced somewhat. So I wanted you to see, firsthand that she can't draw the relationship between an employer who says, you know what, I'm going to take that help wanted sign off, or I'm going to cancel that ad that I'm looking for employees, and then I'm not going to fire anybody. But you can see when demand goes down, when they first pull the job opening, the next thing it goes is the employees. And now let's get into today's data, which validates everything. You're going to love this as U.S. retail sales edge higher as key metric shows resilient demand. And well, let's take a look and see how resilient it was, because the value of retail purchases rose 0.2% in June after an upwardly revised 0.5% increase in May. But notably, the figures aren't adjusted for inflation, and that's one of the big problems. And I'm going to show you here in a chart in a little bit of why retailers are struggling here, because they need to see retail sales rising faster than inflation, and when they don't, well, that means they're actually not making the money they need to make, and that means they can't afford those higher rent costs, they can't afford those higher business costs, and they certainly can't afford the higher labor costs. The so-called control group, this is almost interesting here, which used to calculate gross domestic product and exclude food and services, auto dealers, building materials, and gas lease stations accelerated 0.6%. Well, that'll help the GDP data the next quarter for sure. But now let's take a look at inflation-adjusted retail sales. We're going to take the year-over-year rate of change of retail sales, subtract off the year-over-year rate of change in the consumer price index, and what you can note that is negative. So this is bad for retailers. This is not what they need to see. Normally, you want to see retailers doing business in excess of inflation, and that means there's prosperity for them as well. But notably, you see when it slows down, like it did in the dot-com bubble and went negative for a little bit, well, we had a recession. And then you saw it during the global financial crisis. It went negative. We had a recession. And there's a reason why. I'll show you in a minute. And here we're seeing it again. Now, we're not going to worry about the pandemic, but you see it happening again. And this time, what did the headline say? The consumers are resilient. Well, not for long. Sales increased in 7 out of 13 retail categories last month, better than 50%, including advances in non-store retailers, electronic stores, and furniture outlets. The value of purchases at building material stores, gas stations, and grocery stores declined, which will not feed into the GDP figure. By and large, Americans' finances remain in good shape by historical standards. Inflation-adjusted earnings, which we picked on in prior shows, and we'll do again today, after falling for 2 years, have finally started to rise in recent months, giving some hope to the experts. A report last week showed consumer prices rose at the slowest pace since early 2021. And here's one of the challenges. We're going to not look at just wages. We're going to look at total compensation. So we're going to take hourly wages times the weekly hours worked for production and non-supervisory employees and put that up against retail sales here. And so what I want you to note is as total compensation in red falls, look, we see retail sales go down too. And they almost start to fall at the same time. You see that going right in here to the global financial crisis. They're falling simultaneously. And you see it at the same time that wages started slowing down. So did retail sales. So it's starting to tell you that perhaps there's something with the consumer that the data just doesn't say, that perhaps that their situation is far worse than we realize. But there are growing signs of stress as delinquency rates, and here's one of those signs. Delinquency rates are rising, and nearly 4 in 10 households reported in June that it was somewhat or very difficult to pay for usual household expenses. This fall, student loan borrowers will resume monthly payments, further limiting discretionary purchases for people. So here we see that indication in June, things slow down. So what that means is with a lag, we should see in the coming months that be reflected in the economy, which is interesting because around here, and for those who don't know, I live in the vacation capital of the world. And what's interesting is theme parks are usually busy right now. And what we're seeing in the news is demand for those have been down. The parks that I go to, clearly the demand is down. And I'm going to go do some more research on that here in the coming week. But what's interesting is at the time of the year that the parks should be busy, they're not. But if consumers are under stress, say back in June, well, it makes sense why they're not here. And here we can see that why this decline in retail trade against inflation actually means people are going to get laid off. And this is what I've said, when retailers don't make money, now remember, they've got higher rent costs, insurance costs, electricity costs, all kinds of other sunk costs of doing their business. But the one cost they can get rid of, well, is some labor, particularly when retail sales against inflation is declining and they're not making money. Look at that. The 4-week moving average of initial claims rises with a lag. Here you can see it during going into the global financial crisis. Once again, as that goes negative against inflation, well, you need a lot less employees. We're seeing it now almost lockstep together at the same time, suggesting that even though the data and all the experts say the 4-week moving average initial claims is probably going to roll over and head down, so far the data suggests, against what Janet Yellen is saying, that yes, the labor market is getting worse. And now, of course, we're asking the question is, why am I in a steel mill? Well, check this out. U.S. industrial production decreased in June for a second straight month. The June index of production in factories, mines, and utilities decreased 0.5% for a second month. Manufacturing output declined 0.3% in June. Again, that's a sign demand is going down, my friends. Output of consumer goods dropped 1.3% last month. Here again, we hear this resilient consumer, and you see right there in the data, it went down 1.3%. The most since February 2021, and reflecting decreased production in a broad range of categories, including autos, appliances, and apparel. Output of materials also fell, while business equipment production was flat. And capacity utilization, which is a great proxy for inflation, as factories, a measure of potential output being used, dropped to a 3-month low of 78%, saying their factories aren't being utilized at their limit. It's above 80%. You start to see inflation being a problem. The overall industrial utilization rate slipped to 78.9. And here is the other part of the story. We look at industrial production, and when it slows, what we should expect to see, and what we're going to see on this chart, is when demand slows down and production slows down, what do you need fewer of? Well, employees. You got it. And here you can see industrial production in blue shown on a year-over-year rate of change against the 4-week moving average of initial claims. And sure enough, as industrial production heads down, we see in every instant the 4-week moving average of initial claims heads higher. We're seeing it happen now. And what we're missing here is, of course, what Janet Yellen's missing here is she can't see the double whammy effect that industrial production slowing is going to lead to more layoffs, and that retail sales against inflation is falling, and that's going to lead to more layoffs at a time when you just heard her say that the labor market seems to be holding up. Well, not for much longer. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.